Hi guys, and welcome to another week ahead video. Now in this upcoming week we have a couple of interesting events to focus on. We have the ongoing tensions between the US and China. We also have US political meandering with regards to the stimulus bills, even though we did have a mini breakthrough over the weekend with some executive orders coming through. We also have important US data points coming out with US retail sales and Chinese data as well. The main focus for this video for this week will be on the RBNZ upcoming policy meeting that we have on Wednesday. So join me now to the video to see exactly how we're preparing for this event and how we can hopefully trade them in this upcoming week as well. Alright, now with a very light economic week ahead, we've chosen to take a closer look at the upcoming RBNZ meeting this week with some possible trading opportunities. Now, it should be no surprise that the New Zealand economy has weathered the storm of the pandemic lockdown better than previously anticipated. Now, I agree that this statement is something that holds true for most of the major developed economies, but in the recent note to clients, Westpac Investment Bank summed this up pretty well in the extract below, saying that consumer spending and various gauges of economic activity are now similar to year-ago levels. The decline in employment has to date been much smaller than forecast, and unemployment has remained far lower than expected. The housing market has held up better than anticipated, and export commodity prices haven't fallen at all, whereas we expected the weaker global economy would spark a downturn for farmers. Now, looking at a few recent examples has been the electronic retail sales data for New Zealand, which showed notable improvement recently, and according to Reuters, these numbers offer a very meaningful measure of overall monthly retail activity, as it covers roughly 70% of core retail sales. Another better than expected print was this week's labor market data, which showed a smaller than expected contraction in job growth of negative 0.4% versus consensus of negative 2%, and a much lower unemployment rate of 4% versus consensus of 5.8%. Now, even though these numbers were good, there is some important caveats, such as the fact that fewer people looked for jobs, as well as a big plunge in hours worked. This simply means that the data was less bleak, but there is more pain under the hood. Now, the central bank came out guns blazing previously with ultra loose policy actions due to their initial forecast of the hit to the economy. However, recent data has suggested that the hit was much less bleak than they initially thought. Now, why is this important? Well, if they were too bleak in their forecast, and we know they were, then that means they are going to need to update those forecasts accordingly to portray a slightly better than expected picture. Now, according to Westpac, this is very important because it also means that the Treasury's fiscal update will probably show a smaller government debt forecast than they previously projected, and that is significant because they would also mean that the RBNZ won't have to keep up with the current base of bond buying solely due to government debt. However, does all of that mean that the RBNZ will come out hawkish this week? Absolutely not, and there's plenty of reasons for them to stay dovish. Now, currently there are still a few negatives in the wings that'll keep the RBNZ cautious. Firstly is the exchange rate. Now, the one thing that the RBNZ does not like is a Kiwi dollar that is too strong. And if we take a look at the chart below, we can see that the Kiwi dollar has surged more than 20% since that mid-March lows. Now, that's a lot, and something the RBNZ won't be happy about this week. At the prior meeting in June, the bank also said that the appreciation of the Kiwi dollar's exchange rate has placed further pressure on export earnings. And according to Westpac, the TWI, the trade weighted index of the Kiwi dollar, is roughly 8% above the bank's May forecast and has shown much more resilience than the bank, that is the RBNZ, previously anticipated. Now, this means with a slightly less bleak economic forecast, the last thing the bank will want right now is to send the currency higher. Thus, there is reasonable expectations that Governor Orr might want to try and jawbone the currency lower at the policy meeting this week. The second one to consider is fiscal policy. In the wake of the pandemic, the New Zealand government was eager to boost the economy with ample amounts of fiscal spending. However, the Kiwi dollar 13 billion wage subsidy that no doubt helped to give recent boost to the employment data will expire in September. Also, with the borders closed for longer than previously anticipated, the current job losses, especially in the tourism sector, will be hard felt by many. Now, apart from that, the government has also decided to hold back another 14 billion Kiwi dollars of its current stimulus package. Now, with the government showing more restraint in terms of fiscal policy, that means that the RBNZ will be the one that needs to pick up the slack and continue their ultra loose policy, and of course continue with the stimulus, which includes bond buy. The bottom line is that there are some things the bank can be happy about, that's true, but it is way too early to have a victory lap. If we look at the options market, for example, it's clear that the market is expecting this to be a non-event this week, but with expectations for no changes at this meeting, the generally more proactive RBNZ might use this to their advantage this week. So looking at a few potential dovish shifts, the least dovish reaction would come from the bank, basically just making no additional changes to policy and just signaling that risks are still tilted to the downside. Right now, markets are expecting the current bond buying program cap of 60 billion to stay in place until May 21. Now, if the bank wanted to show their steadfastness in their ultra loose policy stance, they would announce an extension to this program or maybe even expand the cap at this meeting. Now, some investment banks like ANZ are actually in this camp and expects the bank to increase that cap to 90 billion at this week's meeting already. Now, due to the long-term economic uncertainty, most investment banks do agree that the bank will eventually increase the cap, but the bank might take a more proactive view this week and adjust policy accordingly. This type of announcement would certainly be a surprise to most market participants and could also potentially kill two birds with one stone, because such an announcement would also be enough to send the Kiwi dollar lower without the bank needing to step in with possible currency jawboning, and they can keep that one for a later meeting. So the most dovish reaction then would come from an increase in the Kiwi cap unexpectedly, accompanied by jawboning of the currency, which is currently expected, and also sticking to a more bleak outlook despite the recent positive data. Looking at a potential hawkish sentiment shift here, as noted, there is possibility that the RBNZ decides to just use this meeting as a chance to take stock of everything that has happened and basically just continue to give a overall dovish outlook without signaling any policy changes. Now, that is important because given the RBNZ's concerns about the Kiwi dollar's recent strength, we would expect a hawkish shift from the market if the bank doesn't deliver on expectations this week to jawbone the currency at the meeting. Now, due to their concerns about the exchange rate that they voiced in June, if they decide to not even mention it at all, obviously the market will see that as a hawkish tilt, and that would of course be very unintentional from the RBNZ that doesn't want the currency to appreciate. So the most hawkish reaction from the market would be a less bleak economic outlook, followed by absolutely no mention of the Kiwi dollar strength and no further policy action with regards to the bond buying program. Looking at a potential trading plan for the week ahead, the other element to watch this week is the US dollar. Now, it's been on a nosedive recently, given a whole slew of factors. However, some investment banks have argued that the speed of the descent has now gone too far too quick, and it is due for some mean reversion. Morgan Stanley on Friday said that the dollar index is now the most oversold that it's been in the last 4 decades. So the reason why this is important is because most of the majors, apart from the dollar of course, have enjoyed some time in the sun as the greenback moved to the naughty corner, so to speak. Now, we know markets are starting to become more worried about some overdue short-term correction in the dollar, and if we do see the rest of the majors taking some time off, so to speak, and lose some of that recent upside momentum versus the dollar, that will of course affect the Kiwi dollar as well. Another thing to keep in mind for the Kiwi is its risk sensitivity as well as its exposure to China. So any meaningful shifts in risk sentiment or escalations between the US and China will have an impact on the Antipodean currency. So definitely something to watch. Thus, we can pair the Kiwi dollar against the Aussie. That could be a good hedge if we do see any major potential swings in risk sentiment, if we do see a hawkish or a dovish reaction from the RBNZ. Alternatively, if the dollar indeed does move higher and continues a much deeper correction this week, a dovish shift post the RBNZ meeting could be good for some Kiwi dollar, US dollar downside. Just keep in mind, we do have option expiries, not a big one, but a 600 million in call options expiring this week at the 65.25. So just keep that in mind as a potential area of interest where medium-term buyers might want to step in and defend.